Hi, my name is Lawrence. I'm the author of Financial Freedom Through Property. One of the questions I get a lot from my students is it better to invest in a new build or in a property that's been already built many years ago? An example like a CBD kind of area. So in this short series, I'll be analyzing several new builds and just showing why investing in new builds can be risky and can be difficult. If you haven't already, please subscribe, click the notification button, join this tribe. I'll be sharing, as I always do, weekly updates and weekly videos, so make sure that you don't miss out on everything property related in the South African market. Welcome back to another episode of the series of the New Build Dilemma. Now, new builds is a very attractive way for people to get started in property investing because you're buying something that's shiny, that's new, that doesn't require any maintenance. And new build developers and marketing teams for these companies are very good at painting the picture of a new build being a very good, sound financial investment. In this series, we're going to unpack whether it's better to invest in a buy-to-let or into a new build. And the answer, quite simply, is it depends on your strategy, right? Both have pros and both have cons. If you look at your lower income sort of CBD market approach, you're buying properties for 2, 3, 400,000. You're renting for 6, 7, 8,000. You've got more than enough yield to be able to earn a cash flow, a profit at the end of the month. Right, so your income is higher than your expenses, leaving you with a positive cash flow on a month-to-month basis. That's what's great about that sort of lower income market. If you're looking at new builds, the strategy is not cash flow, the strategy is capital appreciation. From a cash flow perspective, 9 times out of 10, the income is going to be insufficient to cover the expenses, leaving you with a negative cash flow in the new build strategy. Right, at least for the first couple of years, let's call it 4 to 6 to 10 years maybe. Now, where the capital appreciation strategy lacks the cash flow, it is strong in the sense that there's a likelihood or a potential for the property to appreciate in value. If you look at your cash flow strategy, the appreciation is going to be minimal, if any. If you're going to see a 3 or 4% capital appreciation rate, that would be probably quite high. Versus your new builds have the potential to appreciate a lot more. Now, I use the word potential and speculation very carefully here because it is a gambling strategy. As much as a developer will tell you that the property is going to appreciate by 8 or 10%, or an estate agent might say that to try and convince you to make a buying decision, the reality is no one knows. And for me, that's why I've chosen the cash flow strategy and avoided the new build strategy, because I don't believe in that methodology. Right, the cash flow strategy, it's about income being greater than expenses. You can predict it, you can plan for it, you get that passive annuity income. The new build strategy works well if you're happy to lose money on a month-to-month basis, but you believe enough in the area that it will appreciate over time. So let's jump into a live example, and I'll take you through how I see a new build investment. Okay, today we're looking again at Central Developments. This is their buy-to-let now offering. Again, I don't have any affiliation to any of these development companies, and I'm just sharing my insights as an investor looking at this. So let's have a look. So the last video that I shared was around the Junction in Centurion. Go check that out if you haven't seen it. Next, we're going to look at Lion Pride in Johannesburg. So again, looks really pretty, looks nice. All your new builds will usually look really visually appealing. Let's go to more info to see a little bit more detail behind this deal. Okay, so it's phase 1 selling. Now, the tendency of development companies to sell this is very powerful. So phase 1 is usually sold as the best time to buy in a development because you're getting in on ground zero. So that means you're buying at the lowest possible price, and hopefully if you buy in phase 1, by the time they're selling phase 4, the property's already appreciated 5% or whatever it may be. So they'll say, if you buy in early, you have the chance to participate in more capital appreciation, which is totally fair. Again, you always just got to remember that appreciation is speculative at best. 0 deposits and up to 100% finance. That's pretty interesting. So the returns. So I'm just going to look at the 3-bed, 2-bath. purchase price of 1.2, rental income of 99, so it's not even got a 10% yield, gross yield. So definitely not going to be cash flow positive. You can forget about that. Levies, rates and taxes, net rental income is 8510, but that's based off of a cash price. Once you put leverage on this, once you put your bond repayment on this, it's going to be minus two grand, and then on top of that you still have to put money away for voids and for management. So this property will probably lose about 4,000 per month, I would say, in terms of your cash flow position. They do project an 8% capital appreciation rate, which is high. In Johannesburg, it's possible. I bought a property about 10 years ago in Fourways, Johannesburg, for the intention that I believed it was going to appreciate in value. I'm selling it now 10 years later, and it's grown by 100,000 rand, which is, I think it's like 2%, 1.5% per annum. So yeah, I mean, that's again why I don't like the new build strategy, because I don't trust capital appreciation. I think it's not that I don't trust it. It's just it's a bit more gamblish or gambling orientated than working out your cash flow. Now, assuming that 8% is an achievable capital appreciation, they're saying that their return is 16.5%. Again, that's only because 8.5% is based off of a cash purchase. As soon as you put leverage in there, your return is going to be minus. It's going to be minus 10, 15%. So I don't know. I don't really like this one too much, just because it's got quite a low gross yield, and none of them really do. The best one is 10%. They're 4-bed, 2.5 bath, but again, the negative cash flow that's going to come from this property is going to be quite hectic. So maybe if you're buying in at phase 1 and you feel super confident that it's going to go up in 10% value in the next 6 months when the final phase is sold, and you feel like you can take that risk, then go for it. But if you're looking for, again, cash flow, these are not the properties that you need to be buying. You need to be looking in your CBD, lower to middle income areas, multi-lets, where you can have multiple tenants, which multiply increases the rent that you achieve. Please don't forget to click like, subscribe, check out the other videos that are coming up soon. I'll be doing a series of different new build developments. Thanks for your support, and please don't forget to share this. Cheers.